Hi, Dave.
Hey, Paula, thanks for having me.
Dave, you talk about creating a strategy, but strategy doesn't just apply to real estate. Strategy applies to a more comprehensive, holistic view of your life. Oh, you refer to this as a portfolio strategy. Can you tell us what you mean by that?
Absolutely. I think a lot of people, when they first start thinking about investing in anything, but particularly in real estate, they want to jump in and buy their first deal. And that is an admirable way to approach it. But for most people, I recommend starting by just sort of taking a step back and thinking about what you're trying to accomplish in the long run. And to me, that's where strategy really starts, is looking at your own personal values, your risk tolerance, your financial goals, your professional goals, and building a real estate investing portfolio from that point. Because as you know, there are tons of different ways that you can invest in real estate, and some of them are better for certain goals and others are better for different types of goals. And by starting with this self-reflection and understanding of your long-term ambitions, you can better pick the right tactics that are going to support the future that you're trying to create.
How do you define the distinction between strategy versus tactics?
That's a good question. And I think especially in real estate investing, everyone calls strategy something different. Like some people call the type of deal that you're doing strategy, like whether it's a flip or a rental. Other people call like single family homes a strategy versus multifamily. But for me, and sort of the dictionary definition of strategy is a high level plan to achieve a long-term goal. And so to me, that's why I think strategy in general as an investor has to be long-term and it has to be portfolio level, because realistically, although we probably all wish that one deal was going to get us to our financial goals, it's not going to happen. In order to get to those long-term goals, you really need to build up an entire portfolio. And so that's how I think about strategy. And then I would personally label everything else as a tactic, because tactics are defined as sort of smaller units of effort that go into your strategy. And so for me, if my goal and my approach was to invest, let's just say my strategy is to work full time at Bigger Pockets, which I do, and build up enough passive income to replace my salary over the next 20 years. That can sort of be my strategy. And then my tactics are buying rental properties, buying short-term rentals, investing in passive syndications, sort of all the different smaller units of effort that I can put in to reach that long-term goal.
Just as an aside, working for Bigger Pockets or working for Afford Anything, these are some of the few jobs where you can just openly state, I'm actually trying to save up enough money to be able to retire.
That's so true.
And everyone celebrates it.
Yeah, everyone else would be like, oh, I hope my boss doesn't hear this. And I'm like, I hope my boss hears this.
Yeah, exactly. You're like, I actually openly discuss it with my boss all the time. And they compliment me for, in fact, it's one of the reasons they hired me, is they like that,
That's so true. We are very lucky in that regard.
Yeah, exactly. Exactly. Now, when it comes to strategy, so there are many factors that a person should take into account. First, when you're identifying what that vision is, because at the beginning of a journey, you have a certain set of priorities that might inform that vision. But over the span of your journey, and just over the span of your lifetime, your priorities shift. So how flexible should your strategy be?
For most people, I recommend looking at your portfolio level strategy once a year. And I think this is common for a lot of people, whether you're an investor, a real estate investor, or just thinking about your life. You want to revisit your own ambitions once a year. And ideally, some elements of your strategy, some elements of your personal vision should stay the same. Like one thing that I like to do as part of my strategy setting exercise is looking at my personal values. And if you're not familiar with this, just like every company has their core values, I think as an investor, you should think about your values and what you're trying, what things are important to you, what non-negotiables you have. That kind of thing doesn't change all that much for me from year to year, because these are things that are sort of inherent to me and my personality. On the other hand, I also like to think about my risk tolerance. And that does actually change a little bit, especially depending on macroeconomic situations or how well my other portfolio, the rest of my portfolio is doing. If it's doing really well, maybe take on a little more risk in the coming year. If it's not doing well, might scale back and be a little bit more conservative. I think looking at it more than annually does become a little bit self-defeating because you do need to execute. And for things like real estate investing, it can take months for you to take that strategy and then actually go out, find a deal, purchase it, maybe stabilize it, do all the things that you need to do. And if you're constantly just rethinking about strategy, that sort of takes you out of the operations of your business, and that can be detrimental.
You mentioned risk, and I want to dive into that a bit more because there are a couple of topics to cover when it comes to risk. First, big picture, the risk reward spectrum. I'm going to ask more about that in a moment. Let's talk about that first. And then after that, I kind of want to go through line by line the many different types of risks that a person faces. Because often when we talk about risk, oftentimes in the conversation, risk gets lumped into one overarching bucket. But when we delineate line by line what some of these various risks are, we can think, I think, a little bit more critically, more strategically about each one. So with that preamble, first, let's start with big picture. Can you tell us what the risk reward spectrum is as a framework, as a thinking framework?
Yes, I would love to. One of my great passions in real estate investing education is to talk about risk, because I think a lot of people hear that word and they don't want to talk about it. They sort of want to like bury it and not think about risk. But as an investor, risk is not necessarily your enemy. Risk comes paired with reward. And that is the spectrum that I think is important for people to think about, is that traditionally, in almost every type of investment, every type of asset class, the more risk you take on, the more potential there is for return. Now, there are some, assets that are just outsized risk, bad return, and I can think of some very speculative cryptocurrencies that might fit the bill there, that something like that. But for most real estate investments, it is a relatively efficient market where you think about house flipping or maybe real estate development are at the high end of the risk reward spectrum. You can get massive returns. You can get 50% ROIs, even higher in house flipping and development. But even the best house flippers take losses on certain properties. And that's just part of the game. That is part of the risk that those investors take on. On the other end of the spectrum are things like bonds, which offer a much lower return, think like 4% right now. But it is technically, is what most finance people consider a quote unquote risk-free asset. And while no asset is truly risk-free, buying US government bonds is pretty close to that. And so I think this is important because you just need to get comfortable with or decide for yourself what level of risk you are comfortable with and choose the investments that are in line with that risk profile that you have assigned yourself. Like for me, for example, I say that I'm sort of in the middle. I have no real desire to get into real estate development. It's too risky, too stressful for me. Don't want to do it, even though you get great returns. I like the idea of rental properties, and I would consider doing like a BRRRR or renovation part of real estate, a little bit riskier, but I'm comfortable with that. I'm comfortable with short-term rentals, which I would consider a little bit higher on the risk return profile than a traditional long-term rental. And so because I know that about myself, I am able to pick the investments that have the amount of risk that let me sleep at night. And I know that sometimes things are not going to go the way that I want, but overall, as long as I sort of average out the returns that I expect and operate my business successfully, that I'm going to be okay in the long run.
Right, right. And you mentioned short-term rentals often have greater risk than traditional long-term buy and hold rentals or long-term lease rentals. I want to go through, I think, when it comes to line itemizing different types of risks, the distinction between a long-term rental versus a short-term rental really does highlight what some of these line items are, because with short-term rentals, there's greater regulatory risk, there's greater risk of vacancy. So can you talk about some of those specific types of risks?
Yes, each tactic or each deal type in real estate is going to face some risks, and like you said, short-term rentals face more than long-term rentals. Flipping might even face more than that, and development faces pretty much every kind of risk. But yeah, I think that there are multiple types of risk. Like we talk about market risk, that's just risk of macroeconomic conditions changing, where you start to see asset prices decline, really to no fault of your own. It's just something that happens as part of a normal business cycle. But short-term rentals face more of what I would call income risk than traditional rentals. Traditional rentals, this is sort of an old adage and it's pretty obvious, but people need places to live and you sign longer term leases. And so there's less risk in having a contract signed for 12 months versus continuously having to find new guests every 3 days, 1 week, or whatever that is. There's also a higher risk of seasonality in short-term rentals because certain markets are more popular during certain times of year. You also have greater risk from macroeconomic conditions because when people, if something unfortunate happens, the economy dips for a period, people still need a place to live, and most people are not going to give up their primary residence, but they may choose to go on fewer vacations. So that's definitely one element of risk. And then
the pandemic was a perfect example of that.
Exactly. Yeah. So
right.
you see that people were obviously still needing housing, and now we're actually seeing sort of a pullback in Airbnb and short-term rental demand. In just the last 2 years. Airbnb's public company, they stated in their earnings calls that they're down in terms of revenue. So you can see this sort of happening in a lot of places. And then the last one you mentioned too is regulatory risk, which I think exists for most deal types. And by regulatory risk, I just mean there is some risk of government intervention that you don't have any control over. And so in the long-term rental market, that could be in terms of things like the eviction moratorium. That was a regulatory risk for certain people. And there could be rent control. But generally speaking, I agree with you that short-term rentals do have a higher risk of regulation, and it's just happening across the country. You see it especially in major metro areas, Dallas, Atlanta. I think a lot of cities on the West Coast are just limiting how many short-term rentals there are, how they're taxed. And again, these are things that, of course, you can, participate in democracy and go to local meetings and do all of these things, which you should, but you don't have direct control over them. So anytime as an investor, you are subject to factors that are outside of your control, that's sort of the definition of risk.
We are all guilty of waiting to start. I'll start my diet on Monday. I'll start going to the gym next month. As we go into 2025, everyone's talking about fresh starts and goals and resolutions, but you don't need to wait until the new year to start prioritizing yourself and your finances. And that's why I'm excited to tell you about Facet. They've reimagined financial planning with a simple membership model. Flat fees. No percentages, no asset minimums, just straightforward pricing. Whether you're starting a family, buying a home, starting a new career, or just want to travel more in 2025, Facet can help. Their membership includes comprehensive and dynamic financial planning that evolves with you through every important stage of your life. And with monthly check-ins to keep you accountable, you'll never have to make a big financial decision alone. So, no more waiting until Monday to get back on track. You deserve financial zen. Get a head start on your New Year's resolution with a team that will help make sure you stick to it. Visit facet.com/Paula to discover how Facet's flat fee approach could help you keep more of your money while getting the expert financial guidance you deserve. you mentioned income risk. And I want to dig a little bit more deeply into the topic of income, because so often in the world of real estate, people talk about active income versus passive income, but you have a different framework, and it's transactional income versus residual income. Can you explain what that means?
So everyone likes to talk about active versus passive income, and that is important. But I actually think there's almost two concepts buried in the way that most people talk about that. And one is how your income is earned. And to me, that is whether or not you're trading your time for money, or you're trading or using money to earn more money. And I call that transactional versus residual income. To me, when you have a job or any sort of employment or income stream where your pay is dependent on your time and effort, that is transactional. You are trading your time for money. So that is a typical W-2 job. It's most contract jobs, side gigs. And I would even lump in real estate investing activities like house flipping and potentially wholesaling as transactional income, because they are not passive income. That is you putting an effort to earn money. On the other hand, residual income is when your money earns you more money. And so that is similar to when you just put your money in a savings account and earn an interest rate on it. But more applicable in real estate investing would be long-term rentals, multifamily, commercial deals, where you are earning money regardless of your effort. So maybe if anyone owns rental properties, they know this is how it goes. Like you might go a couple of weeks without hearing anything and you're still earning money. And then another day you have to make 5 service calls in a single day. You still earn the same amount of money because you're not earning money based on your effort. It's about your how much capital you have invested into a deal and your rate of return. Then there is also another concept that's just how active you want to be in your property. So if you want to self-manage and be the property manager, that is a very active investment. But if you invest in a fund or a syndication, that is super passive. And I think it's important to make these distinctions because you can have really sort of active residual income, right? So people say like active, I want passive income. I'm going to go burr a property and renovate a property myself. Well, that's residual income, but it's a super active thing for you to be doing. You're going to be on site at that property every single day. Whereas you can also have residual income that is money earning more money that is very passive. And so I think it's important to think about both of those things in setting your own vision and your own strategy, because it could have really drastically different outcomes for both your portfolio performance and your life. How much time you're investing into your portfolio will be heavily dictated on where you fall on these two continuums.
So essentially the distinction is income derived from capital versus income derived from labor.
That's right.
And inside of each of those distinctions, there are more active ways to do so and more passive ways to do so. Can you give an example? So kind of what I'm imagining right now are 4 quadrants, right? 4 categories. Can you give an example from each quadrant? What is a transactional active versus a transactional passive, and a residual active versus a residual passive?
A transactional active would be anything that you're working on a lot. So like that's like doing a house flip yourself. So if you're on there and you're doing a lot of the demolition, installing stuff yourself, that is transactional because it's your labor, but it's also very active. If you have a residual active, that could be like self-managing a rental property, self-managing a short-term rental. And this block of the quadrant, I think, is where a lot of people get hung up because they say, I'm buying a rental property, it's going to be super passive. Not necessarily. It depends on how you choose to manage that. I think the rarest one to find is the passive transactional. That one doesn't really exist that much. There are some sort of fringe cases where, for example, I am investing in a flip, which is transactional, but I'm doing very little of the work. I'm not actually doing any of the labor myself. So that could sort of fall into that category. I'm more of an equity partner in that kind of deal. And then the last one is residual passive. An example of that would be a syndication. And if you're not familiar with that term, it's when a lot of investors pool their money together to buy a large asset like a multifamily deal. That is very passive because you do absolutely nothing. And it's residual because you are putting in money and then not participating in the operations of that business at all.
When it comes to, back to the conversation around strategy, these different types of deals, being an equity partner, kind of a silent equity partner in a flip versus going into a syndication deal. For a person who's brand new, when they're just starting out, they don't know what they don't know. And so they need to learn how to execute good judgment within these spaces. And they need to learn how to properly vet deals. And so there's necessarily going to be some major upfront time that's spent simply in the learning process. Before a person goes too far down each rabbit hole, how do they learn enough to know whether or not a given deal structure should be part of their strategy?
There's a couple ways to do it. Of course, there are more academic ways to do it. In my book, I sort of provide a framework that tells people how to sort of map different strategies to their vision. So, if you're have a certain level of risk tolerance, like given our conversation, if you have a low risk tolerance, you shouldn't consider flipping. Just don't. And don't consider development. Or, if you know that you don't want to be actively involved in deals, then you need to only look for things with the property manager. But I think generally speaking, most investors follow this trajectory where they start as active investors, whether that's in a transactional deal or residual deal. You start by sort of getting your hands dirty a little bit and learning a bit on the ground, and then moving towards passive deals. And I don't know many people who start as like silent equity partners or investing in syndications. I think that's pretty rare. I think your best bet is to pick one of maybe 2 or 3 simple deal structures and pursue them. So just off the top of my head, I'd say something like a long-term rental. And there's different ways you can do a long-term rental, a house hack, a BRRRR. There's different sort of subcategories there. A short-term rental, I think, also can be really good. And maybe just pick from one of those two because they're relatively low risk. They're good opportunities to learn a lot about the business. And from there, you learn a lot about what you like, what you don't like, what you're good at, what you're terrible at. And you can sort of start to refine the types of deals you're looking for based on those experiences.
So what I'm hearing then is that learning comes from doing.
That's a good way to put it, yes.
Well, thank you. Speaking of doing, people have, of course, limited resources. We all have limited resources, but there's really a triangle of resources: time, your money, and your skills. Those exist in relationship with one another. Can you tell us more about how we should think about the resource triangle that we all have and where the push and pull comes as one vertex narrows or stretches?
Real estate investing is unique in that it's not traditional investing, like investing in the stock market, where all you need to make a deal happen is capital. If you want to buy stock, you can go ahead and buy stock. If you want to buy a bond, you can go and do that. But for real estate, you actually need 3 different resources for each deal to be successful. You need capital. That's the money to purchase a deal, finance any rehabs, maintain operations. You also need time because it's a business. And just like every business, someone needs to be putting in time, whether that's you or a property manager. And then lastly is you need skill. You can throw as much time as you want at a problem, but if you don't actually know how to do what needs to be done, you're not going to be successful. And so this combination of 3 resources needs to be applied to any deal, whether it's a flip, a development, a long-term rental, whatever it is. And as an investor, I recommend to people thinking about what resources they can bring to bear for their portfolio and for each individual deal. A lot of people, when they first start out in real estate, think, man, I don't have a lot of money. And real estate, let's be honest, is a capital intensive business. You do need money to get started, but it doesn't need to be your money if you have one of the two other resources. So if you have time to commit, you might be able to manage a property, or you might be able to earn some sweat equity by doing labor for a different type of investor. Or if you have skill, like perhaps you're a contractor, maybe you could become an equity partner on a flip by contributing your effort or management skills to a particular deal. Now, I'll be honest, having capital does make it easier, but there are ways to get into real estate, even with lower amounts of capital, if you can bring the other resources to bear. And that's, to me, the exciting part about real estate investing is as long as you have one or of these three resources, you can buy and trade the other ones. So sort of like the example I gave you, like if you have a lot of time, you can trade for other people's money because there are typically investors who want to buy real estate, but don't have time to go manage a property themselves. So I think that's a really helpful framework for people. And it doesn't have to stay the same for every single deal. Like as an example I gave you before, I'm investing in a flip that I am not participating in terms of any time or really any skill. So in that example, I am using my capital resource to buy the time and the skill of other investors, and we're all doing a deal together. Other deals that I'm doing are where I buy a duplex. I am going to put some time into that. I'm going to put some capital into that. I'm going to put some of my own skill into that. And so the resources I bring to each individual deal are different, but I always try to think about how I'm balancing my resources across my portfolio to make sure that my capital is well balanced between different types of deals. I'm not taking up more time than I care to for my real estate investments, and that I'm actually I'm doing the things that I'm good at to contribute to my portfolio rather than sort of spinning my wheels on the things that I'm not actually very good at.
Right, right. I heard somebody said earlier today, I think it was on Twitter. They said something like, they said it in a much more concise and beautiful way, but the idea of it was don't waste your time doing the wrong job, or don't, stop doing the jobs that aren't for you. They said it much more beautifully than that, but that speaks to what you're talking about.
Oh, absolutely. So it's so true. And especially in real estate, like again, it's a business. And so there are things that you're going to want to do. And maybe at the beginning of your career, you should do that don't make sense as you build a portfolio. For example, taxes. I used to do my own bookkeeping. I'm terrible at that. Yeah. I don't have a brain for it. And so I just was wasting my time. And if I just pay someone to do that, I can actually use my time to go find better deals, and I'll probably get a better ROI on my deals in the long run because I'm paying more attention and doing the things that I'm good at. And that's sort of why I think it's so important to think about this, because you do have limited time and you do have limited skills, and you can't learn to do everything well. And allocating your resources in an efficient way is really sort of the key to building a long-term portfolio.
Adjacent to the topic of taxes, how should an investor think about the different ways that real estate produces returns? Because returns appear in the form of equity growth through principal paydown. They appear in the form of equity growth through market appreciation or through forced appreciation. Returns appear in the form of cash flow. So returns in the world of real estate appear in all of these different variations. And some of those variations contain liquidity and others don't. When a person's deciding how to formulate their own real estate strategy, how should they think through the ways in which real estate biases towards certain types of returns versus other types of returns?
It is very dependent on your personal situation. As an example, I'll just use myself as an example. I work full time and I have a pretty solid paycheck. And so my goal right now is not to earn the maximum amount of cash flow. I don't need liquidity from my portfolio because I get liquidity from a job. And that's great. And so that allows me to focus on what I would consider longer term, bigger swings. Like I can go for big equity positions and do renovations and or invest in syndications where they're doing gut rehabs on multifamilies, because I don't need to earn cash flow this year or next year. What I'm trying to do is build cash flow for 20 years from now. And so I encourage people to first and foremost think about their time horizon. And if you're not familiar with that term, that just really means how long you're trying to invest for. Because if you're trying to retire in 5 years and you're behind, and maybe you have some good capital and you just need to deploy it, then you probably want to focus more on cash flow and liquidity because you need to replace your income, and you should perhaps select the investment markets and the deal types that are more geared towards cash flow. If you're like me or in your 20s and you're going to, try and retire 20 or 30 years from now, you have a lot more flexibility and you can really do whatever makes sense to you. I think the most common arc that people take is something so it's the scaling path, as I call it. It's like the scaling path people take is what I call like equity to cash flow. Because if you have a lot of equity and you have a lot of capital to invest in real estate, earning cash flow gets quite easy. And I know people are probably thinking, hey, cash flow is so much harder right now than it was a couple of years ago. And that is true if you're using a loan. But if you have a lot of equity, you might not need a loan. And I think that's what a lot of people do in real estate is they invest for equity. They try and build up as much capital and principal as they can. And then they buy deals either for all cash or for 50% down or 60% down because it's low risk, which is something you usually want to do when you are no longer earning transactional income. You want to probably lower your risk profile and then just focus on deals that can earn you a lot of cash flow. So not everyone follows that path, but I do think it's sort of a typical and common sense approach if you're trying to chart out the next 10, 20 years.
All right. The final topic that I want to talk about is deciding which markets to invest in. One of the most common questions that I hear from the Afford Anything audience is, should I invest locally where the returns may or may not be lower? Well, typically, if they're asking this question, it's because they believe the returns lower are going to be. So should I invest locally where my analysis tells me that the returns may be lower? Or should I invest out of state where I could potentially receive higher returns, but there's going to be additional friction related to doing the deal? How should a person think through that?
I know that people hate this, but it really all depends. That's the only honest answer. I will say that all things being equal, if your return on your target type of deal is going to be anywhere close, local versus out of state, do local. Even if it's an hour drive, even if it's a 2-hour drive, it is a bit easier, especially when you're first getting started. But if that's not you, then out of state is great. I do it personally myself. But I think the way to think about it is sort of related to your previous question, which is what kind of returns do you want to get? Because pretty much every market in the US, and for those of you who don't know me, I sort of study different real estate markets for a living. So this is a topic I like to think about. Pretty much every market in the United States can earn a solid return at a specific strategy. Now, if you're on the West Coast, is cash flow going to be easy? Probably not. But flipping can be extremely profitable in cities like LA or California or San Diego because the equity positions can be huge. Likewise, or sort of on the other side of the spectrum, the Midwest offers the best cash flow these days, but probably not going to appreciate as quickly. Maybe short-term rentals don't work there or commercial deals don't work there. And so if you know the type of deal that you want, I would customize or sort of choose markets accordingly. So if you're really interested in cash flow, but you live in LA, probably invest out of state. That one's like kind of an obvious answer. If you live in one of these, what I would call hybrid markets, which is where you can expect decent appreciation and decent cash flow, those are the kind of markets I personally like. I don't really go for the sexiest markets. I look for places that have good population growth. I can earn a 3-4% cash on cash return minimum. I can expect appreciation every year. And if you just do that, I know it sounds boring, but like if you get 3% cash on cash return, pay down your loan, you will earn better returns than the stock market by a couple percentage points usually. Usually you'll get 10, 12% annualized return versus the stock market, which is 8. And so I encourage people not to think about maximizing their cash on cash return, which is I know what a lot of people want to do unless they're close to their time horizon. Because if you invest in your own local market, that cash flow will grow over time. If you have fixed debt, your expenses are going to stay relatively stable and your cash, your rent is going to go up over time. And so you'll be earning more and more cash. And so as long as it's cash flow positive in the beginning, it's only going to get better from there.
And I'm sure we'll close out with this. I'm sure you get this question a lot, but in 2024 or 2025, for long-term buy and hold residential rental property investors, do you have any favorite markets?
Yeah, so I'll give you a couple. Let me think about a couple geographically diverse ones, because some people always just say like the Southeast. I think Tampa is a really good market in Florida. I do like cities like Savannah in Georgia. In the Midwest, Columbus is really has strong fundamentals, but it's getting pretty hot there. Indianapolis is really good. And there's a bunch of cities in Wisconsin, actually, like Madison, Green Bay actually are doing really well. And then let me think of one on the West Coast. The West Coast is a little bit harder right now just because cash flow is so difficult to find. There are good markets that have great fundamentals, Denver, Salt Lake City, but they're relatively expensive. So I think the Southeast, Midwest are pretty good. And then honestly, people ignore the Northeast, but there are actually good markets there too, like New Haven, Connecticut. You see Manchester, New Hampshire. Those are all a couple places that I recommend you can check out.
Excellent. Well, thank you so much for spending this time with us. Where can people find you if they would like to know more?
Of course. Thank you. You can always find me on BiggerPockets or on Instagram where I'm at The Data Deli. Or I also have a podcast called On the Market that talks about real estate investing news, data. If you're a nerd and like to follow that kind of economic stuff in detail, you can check that out.
Great. Thank you so much.
Thanks, Paula.